Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing NXTSTAR stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 5.3 billion market cap. They're trading at $163 a share, and they have 33 million shares outstanding. NXTSTAR produces and distributes news, sports, and entertainment across TV and digital platforms in the US. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow looked really good in 22 and 23, up to 1.2 billion. Then down 32% into 2024, 850 million, down another 27% into the trailing 12 months, 619 million. Margins were cut in half. It was 24%, now it's 12%. Free cash flow margin is the percent of the revenue that's converted into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. Nearly 1 billion in 23. Down 64% into 2024, up 25% into the trailing 12 months. So it's currently at 432 million. Net income margin 9%. It was 19% in 2023. Revenue is a sales for the company, and that looks terrible. It did go up 12% from 22 to 23, but then down 5% into 2024, up only 1% on the trailing 12 months. They do pay a nice dividend, 4%, and they could cover that dividend nearly 3 times with their free cash flow. It cost them $210 million to pay the dividend. The way you calculate that, you take their dividend yield, 4%, multiply by the market cap, 5.3 billion. That's how you get to 210 million. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 12.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $11 billion. We divide that by 33 million shares. And we get a calculated stock price of $342. They're trading at $163, so they're trading at a 52% discount. It's a really strong buy according to the model. The future free cash flow estimates look really strong. I think a bit too strong, because look how low it was in the trailing 12 months. To make up for that, I gave them a really high whack, 12%. Let's say I gave them a lower whack, 10%. Then the stock would be $435. The higher the whack, the lower the valuation. Maybe I should have went a little higher, maybe 15%. Even at 15%, the stock still seems undervalued, but they need to hit these free cash flow estimates. If that happens, the stock is definitely a buy. Simply Wall Street is real bullish on this one. They're at 444. They say the stock is 62% undervalued. 10 analysts priced this stock at 198. They say it's slightly undervalued. There are 42 companies in the same industry as NXTSTAR, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 140 million in capex. These are on the investments in property, plant, and equipment. Half the average, almost triple the median. They are a bit leveraged. Debt to equity ratio of 3. For every dollar of equity, $3 of debt. Which is better than the average though, because some companies are really leveraged. Look at this, Warner Music 8.8, Cinemark 9.3, Dave & Buster's 9.7. Remember going to Dave & Buster's as a kid? So much fun. They pay a really nice dividend, the highest on this list. But do you think they'll be able to sustain that dividend in the future? I'm not too sure. They do generate a good amount of free cash flow, a little less than the average. They rank 13th in market cap at 5.5 billion. Price to book is between the median and average. Really good PE, really good price to free cash flow, and 9. That's real impressive. Look at Warner Bros. Discovery, 2.9. Price to sales also better than the median, so they have pretty good price multiples. 5 billion of revenue. And they're growing a lot. Their 5-year annual revenue growth rate is 13%. Roku is number 1 at 33%. Here's their latest income statement. Revenue, pretty much flat from last year. Second quarter of 23, 1.27 billion. Second quarter of 23, 1.24 billion. Operating expenses, a little lower than last year. Their direct operating expense, all the expenses that are directly tied to generating the revenue, 552 million. So operating income is much better than last year. Last year, 179 million, now it's 240 million. Higher revenue, lower expenses, that's a great formula. Their income before taxes, 149 million, 43 million of taxes. Net income, 106 million. about 30% higher than last year. EPS of $3.59. And look at that, they're buying back stock. Last year, almost 36 million shares outstanding. Now it's under 33 million. So to summarize, I have them trading at a 52% discount. They look pretty attractive. I give them a ranking of 8 out of 10. Would I buy it? 8 out of 10. I like that they're buying back a lot of stock. I am a little concerned that their revenue and free cash flow is getting worse, but I think they'll adjust, and I think that'll improve a lot in the next year or two. Really good ratios, 8 out of 10. Great PE, great price to free cash flow. Financials look pretty weak. Free cash flow is going down quite a bit, nearly cut in half from 2023 to the trailing 12 months. Revenue is also down from 23 to the trailing 12 months. This is a really common trend with high inflation. Companies tend to make less money or start losing money, but they have to adjust. How do they adjust? They raise prices. And you may lose some customers, but your margins go up and you become profitable once again, or more profitable than before. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.